So let's get straight to the first management that we have on the show, Polycab. That's the first corporate on our radar today. The numbers look quite good. The problem is yesterday the stock did come off the high point of the day, but that's predominantly because of valuations. To understand more about the past quarter and the way ahead, we're joined by Mr. Jaisinghani, the Chairman and Managing Director of the company, and Mr. Tongia, the Executive Director and CFO of the company. Good morning, gentlemen. Thanks so much for joining in. Well, let's clear out a couple of details. Very, very impressive revenue growth is what you've given in the cables and wires business, but we're missing out on the volume number. Now, we have it at the unofficial number. I think it's around 30% odd. But could you clarify what was the volume growth for the past quarter? What was the price growth as well in the domestic market? And have you gained any market share? Have you outgrown the market?
Good morning, and thank you for having us. Your unofficial number is right. It's 30% in domestic business. There is a very limited pricing effect. It's probably 2-3% here and there. So entire growth, what we are seeing in domestic business is coming from volume growth. As far as market share is concerned, it appears that we would have gained market share, but we probably will have to wait for the other companies to declare their results. And probably after that, we can take a view on that.
Mr. Tongia, compared to the first quarter, good morning to you and Mr. Jaisinghani, Prashant here. Compared to Q1, this is a bit of a drop-off, isn't it, on the volume front? I remember Q1 numbers were the range of 45-50%. What is a sustainable number from here on? Because there were some industry capacity constraints as well, which may have helped at the margin over the last 2 quarters. But what's sustainable from here on the volume front?
So as part of Project Leap, and about which we spoke in the last interaction as well, we aspire to get to 20,000 crore rupees of top line. And this ambition was set in 2021. As of now, we have done 8,000 crore rupees of top line in the first half, and it appears that we should be able to get to 20,000 crore rupees top line before fiscal 26. So the guidance is fiscal 26. As far as volume is concerned, we firmly believe that our volume growth is going to be better than the industry growth. I won't be able to give you a very precise growth target on volume, but I can tell you that it's going to be significantly better than the industry growth, both in the domestic arena as well as the international business.
And what should domestic volume growth be, industry, in the ballpark?
So it depends on the various factors, but if we were to take historical data, it is a multiple of, the total growth is a multiple of GDP, anywhere between 1.5x to 2x, which includes volume as well as value. Generally speaking, value is the major constituent of that growth. Volume is the balanced part.
Mr. Jaisinghani, morning. This is Reema here. Just a quick follow-up. When do the industry capacity constraints ease off? That's question number one. And also, if you could tell us what the export performance has been this time around.
Demand is basically going up continuously because of infrastructure work. So capacity, what is there today, it is going to be concerned within 2 years.
And so, what about exports? What was the performance in Q2? What can you guide for the second half of the year? And you had earlier spoken about how exports can contribute about mid-teens to your overall portfolio. Where does it stand at right now?
So let me take that. Exports is around 400 crore rupees in the second quarter. Between Q2 and Q1, we would have registered a growth of almost 14%. As part of Project Leap, we aspire to get to 10% of exports contribution to the top line. And currently, we are hovering around that, around 9-10%. Exports continues to be a focus area for us and a good growth driver. There are large economies like US, as well as Middle East and Australia, where we are seeing a fair amount of momentum. And we believe on a mid-to-arm to long-term basis, exports is going to be a positive both for the industry as well as for our company.
Okay, all right. Gentlemen, I wanted 2 numbers from you all. One is on the margins. The last time around, you all were guiding for 12 to 14%. Well, in the cables and wires business is a little better than that. Now you're going to be spending more on advertising as well. So give and take everything. The higher ad spends, the movement in raw material cost, what could the margin number look like? You could give it to us for cables and wires and also the blended margins. And also I wanted to ask you about, your working capital days. That's moved up because of a shift in payable days. What is the likely number? So 2 numbers, margins and working capital days.
Sure, thank you. So as far as cable and wire is concerned, we'll continue to maintain margins between 12 to 13-14%. That's the traditional margin range as well. You're right. We have upped our investment on advertisement publicity. In fact, in this current quarter, we have relaunched our logo and carried out a brand refresh. We'll continue to make that investment. Generally, it is around 2.5% to 3% of our B2C business. In the coming years, it's possible that we up it and take it to 3 to 5%. As far as FMEG is concerned, that is slightly softer for us as of now, but we believe that we should be able to get to 10% of EBITDA margin in FMEG by fiscal 26. On working capital, your observation is right. We are around 50 days of working capital, which includes both receivables, inventory, and payables. Generally speaking, our receivables are anywhere between 25 to 30 days, and difference between inventory and payables around 25 days. And we believe that anywhere between 50 to 60 days of working capital is sustainable for us.
But I think you're being conservative on the margins. You're again talking about 12 to 14%, and you've done more than 14%. On a blended margin basis, would you like to revise the guidance upwards? Now, for the last quarter as well, you've done around 14.5%. I think bite the bullet. Don't you think you want to go ahead and revise that guidance upwards?
That's a great one from you. So as far as margin is concerned, I think it's best that we maintain equilibrium between the top line growth as well as EBITDA margin. And we believe that a range of 12 to 14% is sustainable. And that is why we are continuing with our guidance.
Okay. Mr. Jaisinghani, you said that current industry capacity will suffice for the demand for the next 2 years. That's what you said, sir?
Yeah.
So will you, and hopefully things will continue on the infrastructure side in a solid way. So you will have to put up more capacity. Is capacity coming on at other players as well? What is the scenario?
Yeah, we have to increase the capacity because nowadays the infrastructure work is going on very, very fast. And today demand of all utilities have increased, building construction is increased, everywhere demand is increasing. So everybody is trying to increase the capacity. We are also on that phase, which is we are thinking to increase little capacity 25-30% more because we know that demand is going to be coming continuously.
Mr. Tongia, talking about capex, you already have a 700 crore capex plan where you are setting up that extra high voltage facility in Halol in Gujarat. This comes on stream in FY26 in this 20,000 guidance that you have given. Does it include any revenues from, EHV, or is it going to come only after? And what will the margins be once it comes on stream?
So as far as 20,000 crore guidance is concerned, that excludes the new facility, which will be operational in fiscal 26. The margins are going to be in the similar range of cable and wire in the early teens, and working capital is also expected to be of similar magnitude.
In which quarter does the FMEG business break even? The 10% by 2026 you all have been saying for a while, but when does it break even? Sometime early FY25?
My sense is every quarter we should be able to improve a bit. Though what you have noticed is right, that the is slightly negative even now, but that is after considering the additional A&P spend which we have incurred in the current quarter. So the actual real profitability indeed has improved from first quarter to second quarter. We'll continue to make investment. We'll continue to pay attention to profitability. And my sense is every quarter we should be able to improve our profitability on FMEG.
Okay, all right. We'll leave it there, Mr. Jaisinghani, Mr. Tongia. Appreciate both of you coming on early on CNBC and sharing all those details with us. It's been a fabulous run, and we wish you all the best for the future as well. So.